Hello, you're welcome to the 10th session of Business Mathematics. Today we are looking at what is called capital investment appraisal. The session goes should be able to understand what payback period is, net present value for equal lifespan of a project, non-equal lifespan of a project, what is called internal rate of return or minimum acceptable rate of return. Right. So let's look at what capital investment appraisal basically is about. Most of the times, business make a lot of decisions based on an investment, a project, or a purchase of a machine. Right? They make all these decisions and they will want to know the returns on an investment they will make or how much the investment is worth at a future date or even how or when they are going to recover this investment or the initial payment or the initial cost they are incurring. When are they going to recover this initial cost? That is what capital investment appraisal is about. So they take into consideration these investment techniques to help them make decisions on the investments they have at hand, right? Oftentimes, since money is limited and there may be a number of competing investments, like projects, you have project alternatives. One is compelled to select the project whose capital outlay, right, is within budget and also offer the best return. This lecture, the purpose presents techniques for analyzing and selecting business projects or investments. Capital investment is a project which consists of, an outlay of capital as initial outlay, a set of estimated cash inflows and outflows over the life of the project. Optionally, a risk settlement figure, which might be caused by a resale of a plant or a cash settlement to clear any liabilities incurred. Right. So let's continue. These are the techniques. The first one we look at is what is called the payback period. These are the investment techniques. Right. So we have the payback period. Payback period basically has to do with when these businesses are going to recover their initial cost, right? The earliest possible time a business can recover its initial investment or an initial investment. So we have what is called a non-discounted approach where interest is equal to zero. It doesn't take into consideration the time value of money, right? So it could be a payback period question, which is having no interest rate. It is called a non-discounted approach. We have what is called a discounted approach, where we are giving interest rate or interest is greater than what? Zero. Simply telling you that such questions you are given an interest rate and it takes into consideration the time value of money. You can also have payback period questions where it has to do with annuity or equal periodic payments, right? When the inflows are the same, that is what this is trying to say. The other technique is net present value. For equal lifespan of projects, they have the same, and for non-equal lifespan, and what is called annuity or annual worth, right? The last technique is what we call the internal rate of return or minimum acceptable rate of return, right? So let's look at payback period. Given CK as the cash flow in the period K, when interest is zero, that is the non-discounted approach, payback period, to find the payback period, it says it is CO, the summation as K moves from 1 to N. CK less than or equal to 0. CO over here is your initial investment or the initial cost incurred. The summation over here in the CK has to do with the summation of all your inflows. So you take your initial investment, subtract all the inflows one after the other. So you pick the first inflow minus this initial cost of investment one after the other till you get a value which is less than or equal to zero. That value or that that value that gave you the payback period less than or equal to 0 is, or that year that gave you a value less than or equal to 0 is what you call the payback period. So let's say if we have a cost of 10,000 here, after subtracting that of year 1, year two's inflow, and then we had negative 5,000, which is less than or equal to 0. We say that year 2 give us a negative 5,000. So year 2 is the payback period. And when interest is given, you have your interest rate greater than 0. That is the discounted approach. This is how we deal with payback period. It is the initial investment minus the discounted inflows. So you have to discount all the inflows because we have an interest rate which is greater than 0. Then we do the same thing. The discounted inflows are being subtracted from the initial investment one after the other to gets a value which is less than or equal to 0. That value or that year that gives you a value less than or equal to 0 is the payback period. So CO is the initial cost of the investment for the initial cash outflow, typically negative value in the cash flow analysis. CK is the cash inflow received in each period K. N is the payback period, which is the number of periods, could be years, it could be months, and it takes for the cumulative cash inflows to equal or exceed the initial cost. The summation as K moves from as K moves from 1 to N is the sum of all inflows from period 1 to period N. So if it's 5 years, you sum all of them, taking them one after the other till you get to a period that gives you a negative value, a value less than or equal to 0. Right. Same for the discounted. But here, the summation as K moves from 1 to N is the discounting factor of the inflow. So here we discount all the inflows. We find the present value of the inflow. Remember this formula here, CK over 1 plus I raised to the power N here is the formula for finding what is called the present value of a single sum, right? Okay. The payback period for case of I being equal to 0 can be easily calculated using the formula below. That is when you want to find the number of years or the number of years and days, you could use this formula where TP is the payback period, A is the last period with the negative cumulative cash flow, B is the absolute value of the cumulative cash flow at the end of the period, C is the total cash flow during the period immediately after A. Right? Unlike when I is equal to 0, that is not discounting. When I is equal to, is greater than 0, cash flows should be discounted to their present values before the formula above here is applied, right? We'll look at some examples for us to get this concept very well, right? So let's look at this example here. Find the payback period for the investment with the following cash flow, assuming A, right? Assuming A here, I is equal to 0%. It means that here interest is less than 0, right? You don't have any interest rate here, it is 0. The first instance, B, when I is equal to 0, that is greater than 0, we are given an interest of 10%, assuming 360 days in a year, right? Okay, so how do we deal with this? For instances like this, we have the number of years here, we have the cash inflows and outflows. Year 0, the outflow is 50,000, that is the initial cost or investment. Year 1, we have 20,000, year 2, 20,000, year 3, 17,000, year 4, 14,000. We are being asked to calculate the payback period, assuming I is 0. So what we do is that we find the cumulative of these cash flows. What it means is that you pick the first inflow, you pick the outflow, which is 50,000, minus 50,000 plus 20,000. So we keep adding the inflows here to the outflow. So you get to a period where you have a positive value. Right. So what we do is that Minus 50,000 plus 20,000 will give us minus 30,000. Minus 30,000 plus 20,000 gives us minus 10,000. Minus 10,000 plus 17,000 here gives us 7,000. 7,000 plus this gives us 21,000. So how do you find a payback period? This is the formula that we use to find a payback period. A here is the last period with a negative cumulative cash flow, which is what? This minus 10,000, which is for year 2. So we say that A here is 2. Okay, that is what we have here. B here in the formula says that is the absolute value of the cumulative cash flow at the end of period A. Right. So it is the absolute value of the cumulative cash flow at the end of period A, which is the negative cumulative cash flow here, which is 10,000. Right. That absolute value of that is 10,000. That is, we have it here, 10,000 over the C, which is the total cash flow during the period immediately after the A. So the cash flow immediately after this period here is 17,000. So basically, it is the amount that you were owing before you had a positive value. Here is year 2, that is the number of years. To find the number of days is the absolute value of that cumulative cash flow at the end of that period over the next cash flow during the period immediately after the A. So it is 2 years. To get the days, it is 10,000 over 17,000 times the number of days. That's what you have here. And that will give us 2 years, 211.7 days. That's the payback period is 2 years and 211.7 days. Right. Quite easy here. So let's look at the B, the instance where we have an interest rate being greater than 0. So what happens is that we are going to find the present value. We're going to discount all the inflows. Remember, you have an interest rate. We're going to discount all the inflows first before we find a payback period. So this is what we do. Find the present value of all the inflows using this 10%. I mean, use the present value of a uniform cash flow. Sorry, present value of a single sum. So we'll say 20,000 over 1 plus 10% raised to the power 1. That will give us this. Same here, 20,000 over 1 plus 0.10 or 10% raised to the power 2. This 17,000 over 1 plus 10% raised to the power 3 will give you this. Same for all the inflows for the years, right? So here we'll do the cumulative. The outflow plus this value here will give you this. This cumulative here, minus 31,808 plus this value here gives you this value over 15,289.25. You keep on adding till you get to a period that gives you a positive value. So we say that to find the payback period for this discounted approach and the payback period, it is the amount that you were owing before you had a positive value, which is this here. That is for period 3. So it is 3 years. To find the number of days, it is going to be this same period here. That's the absolute value of this cumulative cash flow here over the next total cash flow during that period, the next one. So it is this value here over this here times 360, and that's what we have here. And it gives us the payback period for the second scenario to be 3 years and 94.7 days. Right. So let's look at this example here. The company has to choose either machine A or machine B. The following are the cash flows for both machines. Which of the two machines should be chosen based on discounted payback period if its interest is A 0% and B 15%? Assume 360 days in a year, right? So we have two machines here to select. So based on the payback period, which machine are we selecting? Remember, based on this earlier scenario, this one gives us 2 years, 211 days. This one gives us 3 years, 94.7 days. We can say that we select this one here because for payback period, you always want to recover your initial investment early. So we select the shortest payback period, right? The earliest possible time to recover the investment. We want to recover it early, so we select the shortest payback period, right? Back to this, we have machine A cost and then inflows. Machine B, we have this cost over here and then the inflows. So this is how we deal with it in the first scenario where I is equal to 0. Right. We will find the cumulative as well. Right. So what we do here is that it is the cumulative here is 50,000 here plus this value here gives us minus 24,500. Minus 24,500 plus this value here gives us 0. So I would say that the payback period here is for I, the payback period for machine A is the end of year 2. So we say that here we had what um we had payback period to be 2 years. Right, the payback period for machine B, looking at this, the cumulative, this value here, negative 45,000 plus 12,500 gives us this, minus the 2,500 plus 15,500 gives you this value here. And then we'll have the payback period to be 2 years, looking at the negative here before we had a positive, which is year 2. So it is 2 years. To get the number of days, it is 17,000 over here, right? 17,000 over here. Right, 17,000 over here. For machine B, it is 2 years, which is here the negative before we had a positive value. To get the number of days, it is 17 over 21,000 times 360, and that will give us 2 years and 291 days. That is based on this payback period where interest rate is equal to 0. We are going to select machine A because it has the shortest payback period, right? Second instance where we have I to be 15 or interest rate given as 15, we have to discount all the inflows first before we find the cumulative. So after discounting and finding the cumulative, this is what we have for machine A here. These are the cumulative values for machine A. And to find the payback period for machine A, the year that we had a negative value before we had a positive value was year 2. So it is 2 years. The number of days is this same value here, the absolute value of this 9,301 over 17,000 times 360, and that gives us 2 years and 197 days. For project 2 or machine B, we are going to also discount all the inflows here and find the cumulative. After finding the cumulative, this is what we have here for machine B. The amount that we had before we had a positive value was minus 8,702, and that is year 3. Right, how do you find the number of days? This is this absolute value of 8,702 over the next cumulative cash flow, which is 38,000 here times 360, and that will give us 3 years and 81 days. So based on the discounted approach and the payback period, we are going to select machine A because it also has the shortest payback period. We always want to recover our initial investment early. So we select the machine with the shortest payback period, right? Okay. Let's look at situations where we have a payback period question but has to do with equal periodic payment or what is called annual payment. So if the inflows you are having, that's the future values starting from year 1 to the specified years, and then the inflows are the same, but the interest rate is equal to 0, or you're not giving any interest rate, but to calculate payback period, it is just the annual amount over the, so it is just the initial investment, that's the amount invested, CO over A, which is the annuity. Situations where you are receiving the same inflows, say from year 1 to year 6, you are receiving 10,000 throughout the 6 years. It becomes a uniform amount, and then you are given an interest rate because I is greater than 0 here. To calculate the payback period, we use the present value of a uniform cash flow because it becomes a uniform amount. Right, so it is your initial investment CO minus A over I 1 plus I raised to the power n minus 1 over 1 plus I raised to the power n less than or equal to 0. So this formula over here is the present value of a uniform cash flow, right? Right. In the first instance, we had the same payback period question, but the inflows that you were receiving at the beginning of at the end of year one, which is from year one to the fourth year, were different. We had different inflows. But here it says that a company is evaluating the following mutually exclusive projects at an interest rate of A 0% and B 10% per annum. So you see that project one, the initial cost for project one is 150,000, annual benefit is 20,000, the project's life is 20 years. Right. So the cost is 150,000. You're going to receive an annual benefit of 20,000 throughout the 20 years. So every year 20,000. It becomes a uniform amount. Same applies to project 2. It says that what is the payback period for project 1 and 2 at interest of 0%? What is the discounted payback period for projects? Both projects as 10%. Which project should be selected based on payback period, which is non-discounted approach and then the discounted approach. So this is how we solve or we deal with such questions. Say that for situations where I is equal to 0 or no interest rate, it is just the initial cost over the annual payments. For project 1, it will be 150,000 over 20,000. Project 2 to be 80,000 over 15,000. And that will give us project 1's payback period to be 7.5 years, approximately 8 years. And we'll say payback period for project 2 is 5.3 years, approximately 5 years. That is for the non-discounted approach. Let's look at the discounted approach where we have an interest rate, right? So we say that we use this formula. And then because the annual benefit is 20,000, 15,000 for 20 years and 13 years respectively, it becomes a uniform amount. So we use this formula. It is your CO minus the present value of a uniform cash flow, where A here is the annual payment or the annuity. Right. Let's take a look at this here. Remember, for project 1, the life is 20 years. Project 2 is 13 years. When we consider the situation where I was equal to 0, we had the payback period for project 1 to be 7 years, approximately project 2 to be 5 years. Right. Here we do what is called try and error. We kind of take years, a year which is more than the payback period we had, taking interest as being equal to 0 into consideration. When I was equal to 0, we had payback period being equal to 7 years and 5 years respectively. It means that here, situations where we have the interest rate, where we are going to discount this annuity or annual payment, the amount will be kind of small, so the years will be kind of more. Right. So for project 1 like this, we will pick a year which is more than year 7. We'll try, discount it, subtract it from the initial cost. If it gives us a year, a number or a value less than or equal to 0, then that year is the payback period. Right. So we can start from project, for project 8, for project 1, we can start from 8 years. Right. So we say that we check for 8 years. If it doesn't give us a value less than or equal to 0, we'll pick that of 9 years. So it will be 150,000 here minus 20,000 over 0.1 here into bracket 1 plus 0. Or 10%, 1 plus 10% raised to the power 9 minus. If it doesn't give us a value which is less than or equal to 0, keep on trying. Remember, project 1 had 20 years. We'll try, and when you try that of 14 years here, you get a value which is still not less than or equal to 0. So you get 2,766.25, which is not less than or equal to 0. So we try that of 15. So we pick n to be 15 because project 1 has 20. So we are doing what is called try and error to get a value which is less than or equal to 0. So we tried that of 15 and then we had the value to be minus 2,121.59, which is less than 0. So it means that payback period for project 1 using the discounted approach and the payback period is 15 or year 15. So therefore the payback period is year 15. Same applies to project 2. Taking the interest is being equal to 0 into consideration, we have payback period to be 5 years. It means that for project 2, where it's having a lifespan of 30 years, we are going to consider a period more than 5 years using situations or scenarios where we have an interest rate greater than 0. What we do is that we can start from year 6, give it a try. If it gives us a value less than or equal to 0, that is the payback period. We try for year 7 until we get to year 13 if it doesn't, right? So for project 2, what we do is I will pick that of 7, the cost minus the annual benefits over the interest rate plus over the interest rate by this 1 plus the interest rate raised to the power 7 minus 1 over 1 plus 10% raised to the power 7 give us 973.71, which is not less than or equal to 0, right? It's still a positive value here. So move on to year 8. We try that of year 8. So here in place of 7, just change it to 8. We are doing what is called try and error. So we did that and we had minus 23.89, which is less than 0. So we'll say that this is less than or equal to 0. And therefore, year 8 is the payback period for project 2. So based on the solutions above, project 2 should be selected since in both situations it has the shortest payback period. So look at this situation over here. When there's no interest rate, project 1 you had 7.5, project 2 you had 5.3. We are going to select 5 as the we're going to select project 2 because it has the shortest payback period. When we had interest rate being equal to 10, we had project 1 payback period to be 15 years. We're going to recover the initial investment of project 1, which is 150,000 in 15 years time. For project 2, we're going to recover it in the around the 8th year. So project 2 here is also having a shorter payback period. So say that based on situations, both the non-discounted approach and discounted approach, we're going to select project 2, right? Note that the payback period has some disadvantages. It ignores cash flows after the payback period, right? This is just trying to say that you see this scenario over here, payback period only considers the period that the business or the firm is going to recover the initial investment, right? It doesn't take into consideration what will happen after the payback period. Let's look at this. This is having a project life of 20 years. This is having a project life of 13 years. For project 1 here, we had payback period to be 7. What happens from the 8th year to the 20th year? It doesn't consider that project 2 had a lifespan of 13 years. We had payback period here for interest being equal to 0 as 5. What happens from year 6 to year 13? It could also give you some money or some returns during that period. So payback period only considers the year that they're going to recover the initial investment. It doesn't consider the period after the payback period. Right? That is what it is trying to say. The default approach of 0% ignores the time value of money. An advantage of payback period techniques could be that it helps reduces risk due to shorter time to recover the initial cost or outlay. Right. So look at the next technique, which is called the net present value. The net present value is a technique that finds the sum of the present values of all cash flows for each competing alternative. As long as the NPV is greater than or equal to 0, the investment is worthwhile. Net present value. This net present value technique is a build-up of the payback period because it looks or it takes into consideration the whole lifespan of the project or the machine into consideration. It doesn't really look at the period is going to recover and then that is all. It takes all the number of years that we have for the project into consideration. And this is the formula that we have for net present value. Summation as k goes from 1 to n. Ck, that is your inflows, discounts them, right? So the Ck, the first inflow over 1 plus the interest raised to the power n, okay, minus CO, which is the initial outlay or cost, right? So when NPV is greater than 0, the project or investment is profitable. If NPV is equal to 0, you'll say break even. At the moment, you say total revenue is equal to total cost, or the return on investment is the same as the return from the risk, or it's risk-free investment. NPV being equal to 0 implies that your required return has been met exactly. So for example, if you wanted 20% return on your investment, you have achieved it if NPV is equal to 0. NPV being less than 0 project means that it's not profitable. For a firm, it means the investment adds no value to the firm. So let's look at NPV. NPV just goes beyond payback period. Right? Okay, so this is an example to explain how we use the NPV. Okay, so a company has to choose either machine A or machine B. The following are the cash flows for both machines. Year 0 to year 1 here. These are the present values or the initial cost. Here are the present value. The future values from year 1 to year 4, right? For machine A and machine B, you have the formula here. Assume machine A has a scrap value of 5,000, machine B has a scrap value of 4,000. Which of the machines should be chosen based on the pay net present value if interest is equal to 20%? Right. We have the cost and then the inflows respectively. NPV goes beyond payback period. It takes into consideration the whole lifespan of the project. NPV is a purely discounted approach. We don't have a non-discounted approach for NPV. It's a purely discounted approach. So you always have an interest rate greater than 0. Here, machine A has a scrap value of 5,000. Machine B has a scrap value of 4,000. What is scrap value? Scrap value, also known as residual values or salvage values. And then it simply means that assets, after going through some use or they are being used for some time period, due to some reasons, they could either wear or tear, right? It depreciates. So the firm decides to sell it at a scrap value or at a salvage value. So assets are disposed of at the end of their useful life. So when the useful life of the assets comes to an end, they can decide to sell it as a scrap value. And that is also an inflow. So it is done at the end of the period. So anytime you have a question under NPV, and then there is a scrap value here, that scrap value is being added to the final year's inflow. So we'll add this 5,000 for machine A to 14,000, which is the final year, giving us 19,000. And then we'll add this 4,000 also to 38,000 for machine B, giving us 42,000, right? Okay. So this is how we deal with this. It says that summation of your CK, which is the first inflow over 1 plus the interest rate raised to the power the number of years minus the initial outlay. So discount all our inflows. We sum them, then we subtract the initial cost from it. So here for machine A, we would say that NPV for A, 25,500, which is the first inflow, over 1 plus 20% raised to the power 1. Plus the next inflow, 24,500 over 1 plus 20% raised to the power 2. That is year 2 here. Same for year 3. Then year 4, we add the scrap value to it, giving us 19,000 over 1 plus 20% raised to the power 4, because that is for the 4th year. We sum them, then we subtract the initial cost for machine A, which is 50,000. That gives us a present value or net present value of 7,264.66. Same for machine B, the same procedure. Discount all the inflows from year 1 to year 4. Add the scrap value to year 4 whilst you are discounting. Find the total and then you subtract the initial cost from it. That will give you an NPV for machine B to be 8,587.968. So based on the net present value approach, machine B will be selected because it has the highest net present value. Right? If it has to do with net present value, we select the machine or the project with the highest NPV. Right? Okay. So let's look at another situation like this where we have NPV where the inflows are uniform, 26,000 year, 21,000 year for 16 years and 10 years respectively. The company is evaluating the following mutually exclusive projects. Project 1, initial cost 20,000, 200,000, sorry, annual benefit 26,000. Project 1 has a life or years, 16 years. Project 2, initial cost 100,000, annual benefit 21,000. Project life is 10,000. Sorry, project life is 10. Which project should be selected based on the NPV at 6% per year? Okay, looking at this question, you have an annuity something here because 26,000 for 16 years, 21,000 benefit for 10 years. So it becomes annuity. This is how we deal with this using the NPV. Okay, so what you do with that? For project 1, you pick using the formula we have here, which is the uniform cash flow of present value of a uniform cash flow. A here is the annuity or the annual benefit for project 1 over the interest rate 1 plus the interest rate to the power n, which is 16 years. Remember, NPV takes into consideration the whole lifespan of the project, minus 1 over 1 plus 6%, right, raised to the power 16 minus the initial investment. So for project 1 here, it is the 26,000, which is the annual benefits, which is the A here as well, over the interest rate, which is 6%. 1 plus the interest rate to the power 16 minus 1 over 1 plus 6% raised to the power 16, right? Then we'll find that value, subtract the initial cost of 200,000 from it. That is what we have here. The NPV for project 1 becomes 62,753.25. Same for project 2. The annual benefit is 21,000 over the interest rate 1 plus the interest rate to the power 10 because it has a life span of 10 years. Same, find the sum here, subtract the initial cost, and we have the NPV for project 2 to be 54,561.83. Based on NPV, which is a purely discounted approach, project 1 should be selected because it has the highest net present value. Right. Move on to this. Should note that when evaluating 2 or more projects or investments, choose the project or investment with the highest NPV in terms of revenue, and choose the project or investment with the least NPV in terms of cost. So if the net present value has to do with profits or revenue, select the project with the highest net present value. If the net present value has to do with cost, select the project or machine with the least cost. Right. An example here, the company is evaluating 2 projects with the following information. Project 1 requires an investment of 500,000, an annual revenue of 80,000, starting in year 2 and increasing by 2,000 per year till the end of the project. Project 2 requires an investment of 300,000, annual revenue of 50,000, starting in year 3 and increasing by 8% till the end of the project. Calculate the net present value for both projects if the lifespan for both projects is 14 years and the interest rate is 10% per year. Right. Looking at this question over here, the project 1 over here, right? Project 1 over here, investment is 500,000, annual revenue of 80,000, starting in year 2 and increasing by 2,000 per year to the end of the project. This has to do with what is called the arithmetic gradient cash flow. You have an annual revenue, a cost of 500,000, revenue of 80,000, but it's increasing by 2,000 every year for 14 years, from year second year to the year 14. So we use what is called net or present value under what is called the arithmetic gradient cash flow. When you're receiving a uniform amount, but it is increasing by a fixed sum, we say it is NPV is equal to the PA plus the PK minus our CO. PA here, we'll say is the present value of a uniform cash flow. This formula over here, we fix in the values, which is the annual revenue, giving a rate of 10%. Number of years from year 2 to year 14 is 13 years. That will give us this value over here. To find the PK, the formula is K, which is a fixed sum, which is being increased by 2,000 per year to the end of the project. That will be this formula here, 2,000 over interest rate squared, 1 plus the interest rate to the power 13, minus 13 times the rate minus 1 over that. That gives us the PK value to be 66,754.239. Find the summation of the PA and the PK, the arithmetic. That will give us a total sum here. Then what do we do? The next thing is to find the present value of the total sum for the arithmetic. And that will give us 577,293.54. And to get the MPV, we subtract. So basically, we have the summation of the arithmetic to be this. The next thing is to discount this, take it back to period 0, and that should give you this value over here. Subtract it from, we have this value here. After taking it to period 0, we take out the initial cost from it, and we have the net present value for the first project to be this, right? For project 2, when you read here, it says that project 2 requires an investment of 300,000 Ghana cedis, an annual revenue of 50,000, starting in year 3 and increasing by 8% per year to the end of the project. Calculate the net present value, same number of years with the interest rate. What we do is that when you read through here, it is increasing, but it's increasing by a rate. This is another type of cash flow, which is the geometric gradient cash flow. And when the interest rate is not equal to the growth rate, this is the formula that we use. So we find the present value of that, we subtract the cost of 300,000 from that, and then it will give us this value here as the MPV. So based on the two projects, we are going to select projects 2 because, sorry, I think we select project 2 because it has the highest net present value, right? Project 2 has the highest net present value. Okay. This is another question on our NPV. You can give it a try. Discounted approach, discount them, find the sum, subtract the initial cost from it for project 1 or machine A and machine B. Select the project with the highest NPV, and that should give you this. So you're going to discount them, subtract the cost, that gives you this for machine A, same for machine B, and then basically you're going to select machine B because it has the highest net present value, right? The next one under the NPV or follow up, I would say, has to do with annual worth. Annual worth is talking about how much is the project we are taking into consideration worth annually. How much is the project worth annually? Annual worth approach of the net present value is usually used when the lifespan of the project or investment are different. When this is the case, using the NPV approach will introduce what is called bias in the selection process. calculating for the annual worth of each project, first we need to find our NPV. So we use the NPV to calculate our annual worth, right, of a project or investment, and we use it to find the annual worth of the project or the investment. The formula for annual worth, remember, it talks about how much the project is worth annually. The formula for annual worth is from the present value of a uniform cash flow. We make A the subject, and that gives us the annual worth formula. The annual worth formula is basically the annual payment formula under sinking fund, amortization, I would say, or it is from the present value of a uniform cash flow. And when you want to find the annuity, we make A the subject here, and that gives us the present value of, it gives us the annual worth formula from the present value of a uniform cash flow, right? So we can say that we can find, based on the formula that, or the question we just solved earlier, and we had these two NPVs. We can use these two NPVs to find the annual worth for project 1 and project 2 respectively. And we'll say we'll pick the first NPV for project 1, we multiply it by the interest rate, right? We do this, we find, multiply this, we find that of this, divide what we get here over this, and that should give you an annual worth of 6,209.57. Well, same applies to this over here. Project 2, we pick our NPV, multiply it by the rate, divide it by 1 plus the rate raised to the power 10. We had 10 years minus 1, divided by 1 plus the rate raised to the power 10. We find that of this, write it somewhere, find that of this summation, this value here divided by this should give us 7,413. And based on annual worth, to select the project with the highest annual worth. It has to do with money, right, or revenue. Select the project with the highest annual worth. So based on the annual worth approach, project 2 should be selected because it has the highest annual worth, right? I hope this is clear. Okay, let's look at the final technique or investment technique, which is called the internal rate of return, or what is called the minimum acceptable rate of return. The IRR is the true interest rate earned on an investment over the course of its economic life. IRR is that rate at which the NPV is equal to 0. We know the NPV formula from what we just did under net present value, right? So it's the rate or the interest rate that takes your NPV to 0. And it also helps you to identify the minimum rate of return for a business in this case, right? So that is taking time value of money into account. The internal rate of return is the maximum rate of return that an investment is able to recover its initial capital outlay, which is the CO. And then most organizations have established the minimum returns that any investment must meet. This is usually termed the minimum acceptable rate of return. For such organizations, it is only the IRR. It's only when the IRR is greater than or equal to the minimum acceptable rate of return would the potential investment merit consideration. So this is basically or simply telling you that the IRR, in most cases, businesses also make losses and all of that. But in an instance where there's no profits, but the business should be able to recoup their initial investments, that is when NPV is equal to 0. They have no profits, but they are able to recover their initial investment. This is what the IRR is just talking about, right? So this is how the IRR formula was brought about. So calculating the internal rate of return in or using the interpolation, right? So this is the graph to illustrate how the IRR formula was brought about. Using the algebraic approach, we make use of the interpolation and can be understood through the graph, right? So we have the final formula for IRR here says that it is N1 I2 minus N2 I1 over N1 I2 minus I2. I'll take that again. The final formula for internal rate of return, the interest rate that takes your NPV to zero, it is N1 I2 minus N2 I1 over N1 minus N2. N1 here is your first net present value. I2 is your second interest rate or the arbitrary interest rate that you are going to select. Minus N2 is your second NPV. I1 is the first interest rate that you were given. And remember this first NPV or I1, you use this I1, that is the first interest rate that you were given, to find this N1 here. So you use I1 to find the first net present value. You select any arbitrary rates. That is your I2. That is what you have selected to find the second NPV, which is N2, over the first net present value minus the second net present value. Also, think about this. You should select a value within and the ranges that is quite should be a wide guess, right? Don't select any value which is above 100, 200, 300. And also the IRR that you find at the end of going through this procedure or this process, it shouldn't be a negative value. Your IRR shouldn't be a negative value. If it is so, that means maybe you made a mistake in calculating the NPV, or you selected an interest rate which is too much to bear that you were unable to find out. Right. So the accuracy of the IRR is high when one of the N1 and N2 is positive and the other is negative. Right. So let's take this practical example and then let's look at how to find our internal rate of return. So yeah, a company has to choose either project one or project two. The following are the cash flows for both machines. The hurdle rate or the minimum acceptable rate of return, that's the MARR or the required rate of return of 10% and 20%. So here you're giving the two interest rates. This is my I1, 10%. I2 is 20%. Using the procedure, we have to use this project 1 and project 2, having these outflows and then inflows here from year 1 to year 4 to find our NPV for project 1 and project 2 respectively, and then we can find our IRR. So what we do is that we find the NPV for project 1 using 10%. We say it is 20, we discount them. Remember NPV, we discount all the inflows using the interest rate, then we subtract the cost. So it is 25,500, which is for year 1, over 1 plus 10%, which is the power 1. Same for project 2, 24,500 over 1 plus 10%, which is the power 2, all the way to the fourth one. Then we subtract the cost. Then we have 15,764.29 as our first NPV here, and then our first interest here. So I1 is 10%, N1 is 15,764.29. I2 has been giving us 20%. What we do here is that we are going to find, remember this whole process is for project 1. So same for project 1, we are going to use 20% here. Then we would say it is 25,500 for project 1 over the new interest, what's the I2, minus the cost, and that gives us N2 to be 4,853.4. So here we have our I1 to be 10%, N1 to be this 15,764, I2 to be 20%, N2 to be 4,853.4. We can find the IRR1 to be N1 by I2, that is what we have here, minus N2 by I1, which is what we have here in the numerator, minus N1 minus over N1 minus N2. That will give us IRR to be 0.244 or 24.4%. If it basically means if we discount all these inflows using 24.4%, we should get NPV being equal to 0, right? So we'll do the same process for project 2. Pick 10%, discount all the inflows. That gives you N1. Pick 20%, discount all the inflows, subtract the cost. That gives us N2, and then we can find the IRR for project 2. Okay, so this is for project 2, the same procedure. Select all the inflows, discount them using 10%, subtract the cost, and that gives us N2, N1, sorry, to be 20,905.68, I1 to be 10%. I2 here for project 2 is 20%. Use the same interest rate, discount all the inflows, subtract the cost, and then we have IRR for project. So we have NPV or N2 for project 2 to be 6,753.95. Here we have our I1 to be 10% for project 2, N1 to be 20,905.68, I2 to be 20%, N2 to be 6,758.95. We can find the IRR for project 2 to be our N1 by our I2, that is what we have here, minus our N2 by I1, which is here, over N1 minus N2, that is what we have here for the denominator. And that gives us IRR for project 2 to be 0.247 or 24.7%. So based on the IRR or the internal rate of return, we would select the project with the least internal rate of return or the least interest rate. So looking at project 1, we had 24.4%. For project 2, we had 24.7%. I'm going to select project 1 because it has the least internal rate of return. Right. Okay. We're looking at this here, which is called capitalized cost investment. Right. Where we have this formula here. When investment is for a very long time, right? And when n is infinite, say n is 100, we say that to find the present value, it is your amount over the interest. So if you are receiving 20,000 for 2,000 years, or you are receiving 2,000 forever at an interest of 10%, we say that to find the present value, it is the 2,000 over the interest rate, and that will give us the present value. So say that construction of a hydroelectric dam will take 12 years and it will cost 8 million in each of those years. Net revenue from selling electricity is expected to be 8 million starting in year 13 and continuing at the same amount in perpetuity. I calculate the maximum rate of return needed to recover the project's investment, that's the IRR, and then the net present value for I being equal to 3. And then this is how you deal with it. Right. So this is the illustration of what is being given in the question on a cash flow diagram. This is how it looks like. To find the maximum rate of return needed to recover the IRR gives us NPV being equal to 0. We say that NPV is the revenue minus the costs. So we'll just have to find the IRR first. So PAC here be the sum of the present values of all costs incurred, and PAR the sum of the present value of all revenue to be accrued. Then we say that the cost is equal to this formula is the present value of a uniform cash flow, where I is equal to the IRR. We have A to be 8 million, right? Interest rate right here, that's what you are looking for. Remember, 1 plus the interest is still what you are looking for. Raised to the power the number of years minus 1. Then we can go and find our I, which is the IRR, to be 5.94%. So the rates, right, the rate of return for the investment is 5.94. I'm going through this process over here to, arrive at the final answer for the IRR, right? So remember that the PAR stands for the present value of annuity of receipts, and then the A stands for the periodic payments, right? The discounts, this is the discount rates. The image explicitly states that in this context, I is the internal rate of return, and would say revenue at the beginning of the formula suggests that the periodic amounts is a form of revenue or cash inflow. I guess you've enjoyed this session. I'll urge you to take your time, go through these examples, and then you'll be fine with capital investment appraisal. And I hope to see you in the upcoming sessions. Thank you.